here we go. We're relying on us closing, being able to raise all this equity to close this opportunity. If we
Sure.
don't do that because we're starting from scratch, then you can lose your relationship with your broker.
Let's define the difference between a fund and just a single asset syndication.
Sure. Yeah. So the syndication is a single property entity. So if you identify a piece of property, you're going to say you've got a 300 unit Class B property in Dallas, Texas. You've identified that piece of property. You're going to contact your lawyers. You're going to get an op agreement, subscription package, and a PPM, a private placement memorandum. And you're going to have that tied to that single piece of property. You're going to raise money for that asset, and you're going to close one asset. That's it. That's all you can do is just one asset through a syndication. I kind of call it, kind of like Bridger Pennington calls it, it's a hamster wheel. It's a ton of work.
Sure.
For one piece of property. We're going to just do all this work. We're going to contact our lawyers. It's going to cost us 15, 20 grand. And all that money spent, you've got a ton of risk involved because it's one piece of property. It's not diversified. There's a big responsibility on you, the guy, the sponsor of the deal. And with that, here we go. We're relying on us closing, being able to raise all this equity to close this opportunity. If we
Sure.
don't do that because we're starting from scratch, then you can lose your relationship with your broker. Being non-diversified, you could have some trouble with your investors. If you're dinged on cash flow and your value add strategy,
Yep.
you're not diversified in multiple assets. So yeah, syndication, it's one piece of property, one address, and one opportunity. Those documents are just for that piece of property, and you're only raising for that piece of property.
Yep. So the difference, just to simplify that, right? Summarize it, is when you're doing a syndication, you're pooling a bunch of people, friends, family, other investors' money together to buy a single asset. Usually it's a bigger asset. You're putting usually 35, 30, maybe 40% equity. The rest of it, you're putting debt. And, your returns are directly correlated, causally correlated with that asset and how well that asset performs. So if that asset tanks, your investment tanks.
Absolutely.
Conversely, the fund, right, allows you to diversify because you're putting it in, right? You're getting typically a set return, depending upon how the fund is structured, right? An equity fund versus a debt fund, and so on and so forth, right?
Right.
I think for this particular purpose, we're talking about a debt fund. Am I off there?
No, so you'd be essentially an equity fund. So for instance, my funds are usually a 8% preferred return and 70-30 on the waterfall or carried interest to the investor. So we're sitting beside senior debt. So we're raising that money exactly like a syndication. We're raising money to put in the 30 to 45% down. And then we sit next to senior debt, and then all cash flow of the property rolls back in at 8% level, and that 70% lion's share back to my investors.
Sure. So then in the fund world, right, there's two different types of funds then, it sounds like. We have equity funds. Yeah, for this purposes, right? Just simplify things, right? We have equity funds on one side where you actually can take part in ownership of the asset as well. And then you have debt funds where people just loan, basically you put money in and they're getting a set pref, 8%, 9%, 10%, 12%, whatever it is, right? On a pretty, annual incurring basis. Where we met, at Best Ever conference a few years ago, and then, reconvened back up a few months ago. One of the companies was basically guaranteeing, just on a debt fund, based backed by the good faith of the company and all the other, assets. And so you can have some more security. So funds are a great way because it allows you to diversify between different assets and within the fund, so that you're not just tied directly to that one asset.
Correct. So now, however, you're in charge of writing your PPM, your fund narrative. That PPM is the Bible. So if that fund specifies that you're going to invest in North Carolina, South Carolina, Florida, Texas, on those areas, and then you've probably identified you're going to invest in the DFW area, Houston, North Carolina, and Charleston, or you're going to invest in Tampa, Florida, And then you're going to have a buy box. And in that buy box, you're going to have, we're going to invest in 300 to 600 unit count in size. So 300 doors per asset up to 600 doors. And then we're probably going to spend $50 to $70 million per acquisition. And it's a light value add. So you can't necessarily, structure a fund and then go out and buy a storage unit. You're going to have it structured just for whatever you're going to go buy.
Okay. So correct. So basically you are saying, hey guys, here's the buy box.
Yep.
Right. Here's the assets we're going after. Mm-hmm. If they don't fit within our mission, right, you have our word, we're not doing it. And we can't even legally do it. Right? This is that fund. If you want to go start, move from multifamily to self-storage, that's a whole new fund.
Yeah, that's another fund.